from 10:33, we're going to move on to another topic that's been a very, very hot topic in the wonderful world of fintech in the past couple of years, which is banking as a service. We're going to hear from Gilles, the chair, CEO, founder of Cross River Bank, and my good friend Colton Pond, CMO at LoanPro, about what's really going on in banking as a service. Again, it's been a proper roller coaster ride, right, in the last 12 to 18 months or so, particularly here in the United States. So I'm very curious to get their perspectives on what do we think is going to happen next. Obviously, Cross River, one of the key players in this space, phenomenal business. Right, so please do give them a massive, massive, massive round of applause for the last session before lunchtime.
Hi, FinTech nerds. How's everyone doing? Last session on the main stage. It's great to see so many people here. Gilles, thanks for joining me.
My pleasure. Thank you, Colton.
I'm very excited. So the title of this session, and the last one on the main stage, as I mentioned, Forge and Fire. Sounds interesting, Gilles. But before we hop into content, we were talking backstage. I would love for you to demyth Gilles and who Gilles is. Give the audience one personal thing, the most interesting thing about Gilles.
So I may surprise you.
Okay.
And a lot of people here. I'm actually a licensed and volunteer paramedic, full-time.
Wow.
So 24/7, 365. And I'm licensed in 5 different states. I'm licensed in Florida, actually.
Okay.
New York, New Jersey, Connecticut, and in Israel.
So you're here today?
I'm on call, 24/7.
Hopefully we don't need you, but now I know who to call in case we needed something.
Yeah, hopefully not.
I'm glad you're licensed in Florida. What a great coincidence.
Yeah.
Awesome. Well, let's jump in. Everyone here knows Cross River and the impact that Cross River Bank has had in the sponsor banking service industry, from clients like Affirm, Upgrade, Upstart, Best Egg, just acquired by Barclays, Rocket, Stripe, Coinbase, Current, and I could go on for days and days and days from the clients you've worked with. But what I was really impressed as we first chatted is a little bit about the origin story of how you founded Cross River Bank 18 years ago and the journey that you took. Give everyone a quick overview of how Cross River came to be one of the pioneers in the banking service space.
So the name Cross River, once I tell you where the name comes from, then you understand what Cross River is doing.
Is it the Hudson River?
It's not.
Okay, thank you.
Although I live on Long Island and I cross 2 rivers to get to work every single day, and trust me, it's very painful. Like I have to take the Van Wyck Expressway. For those who are from New York, Van Wyck is synonymous with horrible traffic and nothing else. But nonetheless, this is not where the name comes from. The name is coming actually, if anybody is a Bible reader here, it's coming from Abraham, our forefather. He was called Abraham the Hebrew. Hebrew in Hebrew means the one who crossed over. So he was standing on one side of the spiritual river, and the rest of the world was standing on the other side. It was a world of paganism, human sacrifices, infanticide, obviously believing in multiple gods. So he really tried to instill to the world the concept of monotheism and ethical monotheism, morality, conscience, goodness, kindness. So he decided to cross that river. That's why it's called crossing the river. And we decided to do the same thing in banking. Like, we're going to try to reinvent banking. We're going to try to do with banking a little bit what Abraham, our forefather, did with religion.
I love that. Anyone that's ever talked to me knows that I'm a huge banking nerd and I love looking in the history of banking. One of the early origins of banking in the Western world was the Knights of Templar, and they took a vow of poverty to offer banking services to people in the community, and one of their first products was I had to go from point A to point B, and I would give point A my money or my wealth, and I'd travel to point B, and they would give me my wealth as well. But the Knights of Templar had to take a vow of poverty. So there's a lot more that we need to do, I believe, to bring goodness back into banking in the right way.
There you go.
But on that note, let's jump on in. So one of the things I love about Cross River, been doing it for 18 years. You've talked to a lot of fintech companies, maybe 1,000 plus at this point throughout those years. So you have a really valuable and unique perspective. If you were to, one of the things we want to do at FinTech NerdCon is bring some of the tangible insights that people can implement in their companies, professional lives, and companies that they found. If you're talking to a fintech founder, give us some advice that you would give from the past 18 years of how you would approach launching and founding a fintech company.
So I would say the first thing that you need to understand, and I'm sure that every single founder here, by the way, understands that and abides by it and espouses those ideals. You dealing with the most precious thing that somebody is building, which is their assets. Why is that the most precious thing that they're building? Because without assets or without some sense of earnings, they are lost, and we see that poverty engenders wars. And in order to avoid wars in the world, you want to promote financial inclusion, accessibility to credit, affordability of credit. So those things come at a cost of regulatory compliance, of oversight. Unfortunately, the banking system was built on a very antiquated system of rules and regulations. That is changing, not fast enough. But if you really care about the consumers, and that's really mantra number one, care about the consumers and the customers at large, and care about the assets that they're trying to build and put on their balance sheet, on their personal balance sheet. So once you take care of that component, then the rest is secondary. Technology, friction, frictionless, customer experience, user experience, all this is almost secondary to that mantra of take care of the consumer first. Promote financial accessibility, financial inclusion, financial literacy. That's the business we're in. At the end of the day, the reason why people like the products and services that we're selling is because it is enabling them to do other things with the time that they're saving by not spending 3 hours online at a branch, teller to get their passbook signed at the end of the month, which people used to do like 20 years ago.
You bring up a great point. It's one that I've actually chatted a good amount with Alex Johnson about. And I believe that we have a risk in fintech and financial services today where a lot of the theme around AI is around driving increased efficiency and how to do more efficiently, more with less resources. And it has the potential risk for us to avoid the core things in financial services like relationships, trust, taking care of consumers that may or may not be, likely or not, the most efficient thing to do, but in turn help increase share of wallet, repeat borrowers, loyalty, trust. So on that note, Jill, I also want to get your take on what's forthcoming in fintech. Like, what are the themes, what are the things, what are the products that you're seeing founded that you feel like the next wave of fintech will be represented by? And I assume you're going to talk about stablecoin, but yes.
Yes, of course. I mean, we're going to talk about, but beyond stablecoins, I want to talk about on-chain in general and tokenized everything. And it is quite incredible, and I'm sure everybody realizes that, but we are at the confluence of two of the most transformative technologies in our lifetime. The previous generation experienced the internet and the advent of the internet. And I remember Bill Gates announcing to the world, any computer that has more than 512K will be useless. You don't need that much memory on a computer. Now fast forward, NVIDIA, and then obviously AI, and the computer power of any, by the way, on your phone you have a terabit of data. I mean, this is mind-boggling how the evolution of technology that has occurred. But what happened in the past couple of years, it's unprecedented between cryptocurrencies and AI. And the confluence of those two, there's a reason why they happen at the same time. And it's for us to be able to use it and put it at the disposal of our customers and our dear consumers. So in other words, put everything on chain, tokenize everything, and at the same time use AI to eliminate fraud, to eliminate friction, to eliminate the onboarding process, which is extremely cumbersome and invasive. And there are other ways now to verify and triangulate somebody's data. So AI would enable us to eliminate as much as possible friction as AI becomes smarter and as humans become smarter at using AI. So in 5 years, if I can predict 5 years from now, zero fraud environment. Fraud will be eliminated. Nobody will be able to actually commit a fraud on the internet to steal somebody's identity and to steal their portfolio or their wallet. The same thing holds true with the validity of a bank trying to steal your assets, because there are a lot of bad actors out there. Money laundering, transaction monitoring, all this will be perfected. So that's why I'm super excited about it. The consumers will be protected, financial literacy will be there, accessibility to credit, because the more you make credit access to people without fraud and without people lying on the application, right, the cheaper the credit will be. So it's a self-fulfilling prophecy. So that's why I'm excited about it.
I love it. So in 5 years, you can come back, FinTech NerdCon 2030, and we can talk about fraud and what we're seeing in fraud. That would be awesome.
Yep, NerdCon 2030 in Las Vegas at the Venetian.
In Miami. I don't know if we'll do Las Vegas. All right, let's jump into the topics. This panel, as I mentioned, or this fireside chat, Forge and Fire. So I want to dive deep into some regulatory things that are going on. You mentioned it at the beginning. It's one of the forefront things that Cross River Bank focuses on and does. And there's some interesting topics to focus on here. So the first one is what's going on in the regulatory environment with fintechs getting banking licenses or different charters. So 2 examples. And we all know the new administration is much more open to this than the old administration was, but two examples that folks know. Stripe got conditionally approved for the Georgia acquiring charter in Georgia, and then Nubank, who Chris was here yesterday, applied for a de novo charter with the OCC. The interesting thing with these, though, specifically with Cross River, is many of these companies who are looking at banking charters are also customers of Cross River, Stripe being one of them. So how do you think about that? Like, do you view it as a competition? Are they trying to get rid of Cross River and remove you from the equation? And what does the future of that look like?
So listen, using a bank costs money. We charge for fees, we charge for regulatory compliance. We have stringencies on the regulatory compliance whereby we are requiring our fintech partners to have adequate, what we call CMS, right? Compliance management systems. That means they have to have BSA/AML, chief BSA/AML officers. They have to have chief compliance officers. So if they're going to spend that money and do the oversight, they might as well do the whole thing. Why limit yourselves and then have to pay a bank, a third party that you have to answer to for exactly the same thing, right? So this is where I think, personally, that I'm pretty excited about all these fintech companies opening charters, and the fact that it's opening, that the regulatory environment is opening up to them is, to me, very good news. Item number 1, people have poo-pooed our business model of bank fintech partnership model, including the regulators, including the folks on the Hill. They poo-pooed it for the past 17 years, since we got into the business, right? Suddenly, it validates our business model. So it's up to us to be the best at what we do. So in other words, we bring 17 years of expertise. We bring a regulatory compliance model that is second to none. We bring technology that we actually implemented inside those compliance management systems in order to protect the consumers and protect our partners. The ones that see clear through this, which is, by the way, 98% of the fintechs, they'll continue to use us. Now, the fact that Stripe or Checkout or others are filing for a fintech charter, or rather a Georgia charter for merchant acquiring, they still need to do issuing. They still need to do a fast movement of money. They still need to abide by the Fed. Visa, MasterCard requires a certain amount of capital for you to do a certain amount of transactions. All this still is a fallback to people like us. So they may use that charter, by the way, but they also indicated that they will continue to do business with us. And on the contrary, I want them to grow, because that means, in turn, that they're going to fall back on us to assume and to absorb some of that growth. Because those charters are limited in the amount of products and services and capital that they inject in those charters. That's where we come in, and we provide them with scalability. So basically, it's almost like an aid. They're opening a charter. They're doing one side of the business, one part of the business that they're implementing. The other 90% of the business that they need to do, they'll come to us, and they'll understand the business we're in even better. So again, To me, that's a very welcome development because we can finally prove to the street that our business model is validated. And if we continue to grow at the pace that we're growing, which we think we could, right, about 40% plus on the fintech side annually, then that actually means that our clients believe that we could do a better job than they could do themselves.
Do you see more of these unique charters pop up, like the Georgia Acquiring Charter, for example? But you mentioned a bunch of other aspects. Do you see fintechs applying for these unique charters, or fintechs want to own the whole charter and own the relationship themselves?
So if fintech want to do that, and by the way, God bless them, and I encourage them to do that. However, it comes with a lot of pitfalls. Yeah. Number one, try to convince a company that is not public to venture in convincing your investor community. So in other words, your shareholding, which by and large are venture funds, right? So try to convince a venture capital firm that you're going to grow at only, you're going to be limited for 3 years. You're going to have to inject a lot of capital. That capital is not going to be efficient because you're not going to turn a profit before year 2 or 3. And you have to have a business plan that is very rigorous, that you cannot change on the fly because that's what the regulators want. That's how they bring stability to the fintech charter model, right? So then what do? You can't change your business model. You can't absorb new products and services, and you can't grow at more than 20%. So it's very limiting. So if they want to engage in that scenario, very early on, I suggest that they do that early so that, by the time they start growing really nicely, after they develop their technology, their partnerships, their vendors onboarding, then they can actually start ramping up the customer base.
I love it. All right, last topic, and the topic that ties to the title of Forged in Fire. Y'all been doing this for a very long time and done an incredible job, in my opinion. Us at Loan Pro partnered with Cross River Bank on countless programs, 9, 10, 11 different fintech programs. But the one thing that I want to close this out with today is consent orders and what's going on. So it's no surprise that Cross River Bank over the 18 years has had 2 consent orders. So one in March of 2018 from the FDIC around things like UDAP and others. And then another recent one in March of 2023 with the FDIC around fair lending. So I want to unpack this, and I'm actually really grateful when we spoke that you were willing and comfortable to unpack it. What happened? What have you learned? What's the process? And then we'll talk about the future. But what happened? What have you learned?
So first of all, everything comes as a blessing. That's truly the philosophy that we adopted since our inception. So I'm just trying to identify what is the message that the FDIC is trying to communicate to me beyond the fact that they want to punish a company that they don't really understand first thing about their business model. And this is the truth. Unfortunately, the FDIC, the OCC, at the time the OTS back in 2008, even the CFPB, although the CFPB to some extent started to really make an effort understanding the business models of Upstart, for example, by issuing a no action letter, right? By utilizing AI in their business model, in their modeling. So those regulatory agencies do not understand our business model. So you're just presenting to them a tremendous amount of volume, both on the lending side and also on the BSA AML side with regards to transaction monitoring on the payment side. And then they're scratching their head saying, you don't have enough people to transact all these loans and all these payments. So how are you doing it? And if they're not satisfied with the answer, they're going to say, well, you grew too fast, we're going to slow you down. In certain cases, like for example, to be honest with you, in 2018, having that consent order was a welcome development for us. They asked us to beef up our compliance management system, to beef up our marketing compliance, to beef up our rollout and onboarding of clients, and that's exactly what we did. A year and a half later, we get out of that consent order, we're far better prepared, and that's when a lot of those companies knock on our door and say, we want to do business with you. Are you prepared to receive us? And at that point, we're saying we're better scarred, we understand what the regulators want, and we have a way around it. We have a way to actually onboard you and do a lot of transactions, but we know and understand how to analyze the data and how to communicate the data set to the regulators in a way that satisfies them. So this is the dialogue that we actually established with our regulators from 2018 or 2016, really, when they started, auditing us and talking to us about a consent order. It took about 2 years to negotiate. Fast forward, we're very happy it happened. That's the honest truth. It's a blessing in disguise. So it's not really a black mark, in my opinion. It's a badge of honor. It's like we were destined to get that consent order because that really taught a lot of the fintech players, a lot of the banks doing the same thing that we do. Some of them are on this floor, some of them spoke on this panel. It enabled them to dodge that bullet because they learned from our consent order. They learned from our processes. And I'm very proud of this. The second consent order was more political. It was more under the Biden administration. They really tried to put a stop, not necessarily on us, but on fintech in general. They didn't like crypto. They definitely put a stop on stablecoins, on crypto regulation. They wanted to basically eliminate or put a stop or slow down on the fintech universe. At that time, in 2023, we were by far the biggest fintech bank partner in the country, right? Originating 25 million loans, processing 50 million transactions a month. So now we're close to 1 billion transactions a year. I mean, you're talking about like an 800-pound gorilla. At this stage, the regulator said, who are we going to stop in order to stop the fintech industry? Cross River. So they came up with this consent order on fair lending, which has no teeth. It has no civil money penalties. It has no restitution to borrowers. So that means they didn't feel that the borrowers were actually hurt or harmed. So they just asked us, get your act together on fair lending, and then we'll give you a pass. Now, they didn't have a chance really to carry out that full mission until the new administration comes in, has a different outlook, and now we're out of it. So we don't want to go back, by the way, to another administration and then give us another consent order. So we're getting ready. So in other words, prepare yourself. It's not rosy out there. Even though the regulators are much friendlier and much better understanding with regards to regulatory compliance of fintechs and fintechs partnership models with the banks, still beware of the next phase or the next cycle turning against the fintech industry. Be prepared to fend off those attacks.
So now that you're through it, what's the path forward? You say you're preparing. What does the path forward look like from here, now past 2 consent orders and moving forward still as a fintech, sponsor banking service giant in the space?
So the funny thing about the regulatory environment is that, so you have 3 layers. You have the DC office, which really legislates, regulates, enacts the guidance manuals and the guidance letters. Then you have the regional office, which is usually career people, right? And the regional director sets the tone on how to regulate the banks in their jurisdiction. The New York region has 600 plus banks under their jurisdiction. That includes Boston, New York, and so on and so forth. Basically the coast, and including Puerto Rico, by the way, somehow. So that's a lot of banks. And then you have the folks in the field. Those folks are the one that you interface with. You're talking to them, they examine you, they come to you. We have basically, because we're deemed a complex bank, because of the nature of the business that we do, we have permanent regulators in our offices. That's where you need to develop the dialogue. And those, by the way, because there are so many of the old timers that took the package and left, they're retired. So there's a new crop of examiners that are coming in. Guess what financial products they use?
Fintechs.
Exactly. They use Chime. They use Varo. They use Nubank. They use Revolut. They use Coinbase. So they're saying, oh, finally I understand the bank behind it and how to regulate it, because I'm a beneficiary of those products and services. The dialogue is totally different. And there's a grassroots effort to understand our business model. This is in the last 3 to 4 years. This is new. So we have to take advantage of that. Engage your regulators at any level, engage them, talk to them, and establish a dialogue that will be very constructive.
One of the things on a point that you mentioned earlier that when we chatted, I really enjoyed because I completely agree, is there is a stigma around consent orders, and it is generally a negative stigma for sure. The 2 points I would make here is one, not all consent orders are created equal. There are folks like Claros Group and others who have gone throughout the banking service space and said, here are all the banking service or sponsor banks that have a consent order, and here are the details of them, because not everyone is created equal by any stretch of the imagination. And then two, many people don't know this, but the top 5, the top 10 banks in the US, they get consent orders all the time. Talk through the stigma, how you view consent orders in the future around what that looks like.
So that's a very valid point. I think we make too big of a deal about consent orders. And I remember we were under a consent order, number 1, and then number 2. And we do also a lot of asset aggregation and then sale. And there are some banks that just plain and simple refuse to do business with us. They say, well, you have a consent order, we're not going to buy your loans. We said, but those loans have nothing to do. They were not originated under a regime that actually caused the consent order. The consent order is targeting fintech and has nothing to do with the assets that we're trying to sell to you, which are, let's say, real estate assets or small business lending assets or loans or bonds. And that is mind-boggling to me. There's a stigma around the consent order. We need to eliminate that. Why did the bank get a consent order at the end of the day? And by the way, you could read through those docs and you could actually figure it out. It's pretty public because they really want to make it like a punishment to the bank. Because they think that if they punish the bank by making something public, they're going to learn their lessons and make sure that they don't repeat it the next time. It's like chastising a child in the middle of the classroom. It's exactly the same thing. The child will not repeat their mistake because they're so embarrassed to have been called on of making that mistake. So the banks and the regulators have established that relationship where they put a stigma on the consent order because they hope that it's going to be punitive enough so that the bank is not going to do it again. But if there's no consumer harm, and if there's no foul play, and if it's only a legislative or a regulatory interpretation of the law, then you could figure it out yourself, and then you have to remove that stigma from the consent order mechanism. That is basically what I think about it.
All right, Jill, last question. There are some leaders of banks that do banking as a service, and as the regulators would call novel banking activity, here in the audience. If you were to give 2 or 3 pieces of advice to a CEO that just got handed a consent order, what would that be?
Hang in there. It's all gonna pass. And at the end of the day, we survive too. And I'm telling you, it creates resilience and determination, and you learn how to fix things so that you don't repeat those mistakes. And like I said before, for us, it's a badge of honor. We're very happy that the FDIC actually made us the target because we had the wherewithal to be able to withstand it. So take advantage of that. Like, this is the day after 2 consent orders on Cross River and numerous consent orders on other banks. Most of them survived. There's only one that didn't, but most of them did. And that means that it creates resilience, it beefs up your processes, and through that, you will feel a lot stronger and better prepared to understand what the regulators want and to protect your consumers.
Awesome. Well, Gilles, thank you. I really appreciate the candid conversation and the ability to open the door, Cross River, share deep insights of what you've learned through the process of doing 18 years, and especially what you've learned through these past 2 consent orders and what the path forward looks like at Cross River. And appreciate you being here at FinTech NerdCon. The one shout out that I'd make to everyone real quick is, yes, thank you, Jill. The one shout out I'd make is one of the things that Simon and I did when we thought through sponsorships and also activations in the afternoon. We were talking to the Mercury, FS Vector, and CFIS team, and they, this afternoon, actually are doing a regulatory boot camp. Back there in the boot camp space this afternoon from, I think it's noon, 12:30 to 4, walking people through the regulatory environment. There's actually, at the end at 3:30, a panel that Cross River, Hillel from Cross River is going to join, and send everyone here that joins the boot camp through a mini regulatory exam so we can have more appreciation. The one aspect that I firmly believe is you have three parties here. You have the sponsor bank that owns the charter, you have the fintech, and you have the regulators. And the more often we create dialogue between those three parties, the better. Way too often, we're having dialogue sponsor bank and fintech, or sponsor bank and regulator. The regulator and fintech doesn't often happen, but those three parties coming together, there's a real synergy that exists there. And Jill, thanks for leading the way in what is the embedded finance space today.
Thanks, Colton. Really happy to be here.
Thank you.